Wealth taxes have been growing in popularity in recent days. Advocates for a wealth tax believe it could help with reducing wealth inequality. But is that the case? In this video, I'm going to talk about what's involved in a wealth tax, some of its challenges and resources on the topic, and finally, what we could adopt instead of a wealth tax. A wealth tax is a tax on all forms of wealth. Commonly, it is an annual tax, but governments could also use it as a one-off tax. Some examples of the assets that might be taxed include cash and bank deposits, stocks, bonds, derivatives, crypto assets, directly owned business assets, trusts, real estate, land, precious metals, commodities, art, jewelry, antiques, and collectibles. You can quickly imagine what the process could involve to administer a wealth tax. You'd need to value all of these assets and then tax them a certain percentage rate. The holder of these assets would either need to use existing sources of income or they might need to sell some of their assets to pay for this tax bill. It's pretty easy to understand the first critique, which is the almost inevitability of high administration costs to operate and enforce something as complex as a wealth tax. You need some fairly sophisticated tools if you're going to properly value a vast amount of assets and to also do this every year to generate a fair total value that can then be used to calculate a tax bill. It's going to be really complex to value certain assets like private businesses, paintings, or collectibles and antiques. All of this complexity creates administrative burden and potentially opportunities for tax avoidance, and that's simply because of governments that might struggle to value certain assets. It's going to be difficult to get everything right. The government would need to value basically all of someone's assets and do this every year. The second obvious problem is the opportunity for capital flight. Wealthy individuals can move some of their assets abroad, where jurisdictions have more favorable tax policies, which obviously is going to include the countries without a wealth tax. Some assets won't be able to leave the country, like land or real estate, but some assets can, like stocks, bonds, crypto assets, online businesses, precious metals, collectibles, etc. It would be hard to get every country to agree to implement a wealth tax. If one country doesn't introduce a wealth tax, then that country could benefit from many wealthy individuals that migrate to their country. Countries ultimately compete with one another for talent and capital. So it's hard to believe that every country will act in unison when they all have an incentive to attract wealthy individuals to migrate to their country. Another issue to mention is it's not desirable to give exemptions to any of the assets, as that can just become another way that people use to find loopholes to try and exploit the implementation of the wealth tax. In reality, governments need to tax as many of the different types of assets as possible if it is going to make sure it's not easy to avoid the wealth tax. So the wealth tax could get increasingly complex over time as new and different types of assets are introduced. New assets that now need to be considered and evaluated every year for taxation. You can easily see how this can become an ongoing and potentially increasing administrative nightmare. Let's look at a handful of resources I found on the topic of wealth taxes. One of those articles is from the Tax Policy Associates Group. They start by highlighting the trend of numerous countries that have been abandoning wealth taxes over the years, from a high of 12 OECD countries down to 3 by 2019. This article focuses on wealth taxes and its potential adoption in the UK. It covers why wealth taxes are anti-growth, how it can lead to a fall in foreign direct investment, how it can make UK businesses less competitive, and how it could worsen the impact of recessions. They cover things like the valuation complexities, and then they link to all the relevant sources of data. It's a pretty detailed article, so I'd recommend at least quickly looking over it. And I've linked to that article and the other resources in the description. The next resource from the Tax Foundation goes through the wealth tax related data for a number of countries. One important chart in this resource helps to highlight the difficulty of generating any meaningful amount of taxation income using a wealth tax. As a percentage of total tax income, wealth taxes currently generate 4.35% of the tax income in Switzerland, 0.51% in Spain, and 1.06% in Norway. Not really a very compelling amount of income to justify the adoption of wealth taxes, especially when considering all the complexities that are involved. The final resource is a paper on the cases for and against a wealth tax. It compares the usage of a one-off wealth tax and annual wealth taxes and brings up the point that a one-off wealth tax can be an effective way to pay for any of the costs involved for handling a crisis, where more tax income might be suddenly required. But for annual wealth taxes, they believe that reforming existing taxes, such as capital income taxes or others, appear to be the more compelling solution than adopting a wealth tax. All of these resources help to highlight the realities around a wealth tax and the complexity and limitations in the success, which is evident when you look at the outcomes from the countries that have adopted it. The data and rationale for adopting a wealth tax is not in its favor. But the counter-argument to that is the growing problem of wealth inequality. So a wealth tax could at least help with solving that problem, right? But do we actually need to tax all forms of wealth? The answer is no, we don't. A wealth tax is not a good form of taxation. The income generated is not substantial, and the complexity and burden of administrating a wealth tax doesn't justify its adoption. Instead of a wealth tax, we can instead focus on fixing specific economic systems that are currently broken, like land and money. If you implement a money system that is deflationary instead of inflationary, you prevent assets from continuously going up in price due to inflation. So fixing money is a better way to prevent asset holders from receiving ongoing amounts of unearned income due to asset price increases. I've got a whole video on why money is broken if you're interested in learning about the need for deflationary demerge money. A one-off wealth tax could be useful for generating tax income to help with responding to a sudden crisis. But an annual tax is very difficult to support when you consider the data and the other problems we've talked about. Wealth taxes won't fix the economy. There are better ways to fix taxation and to reduce wealth inequality. As we've already covered in a previous video series, the better solutions that can help to fix the economy include the adoption of land value taxes, deflationary demerge money, and temporary shares of ownership within organizations. If you fix all of these economic systems, it will become increasingly difficult to retain excessive levels of wealth. We'll fix the problems of wealth inequality without the adoption of wealth taxes.